It just goes. So welcome everybody to a virtual fireside conversation about bringing healthcare insurance on chain. I'm John Paller. I'm the founder of Opolis in East Denver. I have been on a mission for a very, very long time to democratize employment and benefits. And, historically, a lot of the conversation that we've had has been largely theoretical or what's possible. And today we're actually landing the plane a little bit. And we've laid some bricks and we're actually doing this now. So as opposed to some, call it pie in the sky blockchain conversation, which we're all very used to doing, we're actually talking today about how this is becoming a reality. And so with me today, I have Lucas from Renzo and Robert from EigenCloud. And I'll go ahead and give them the opportunity to introduce themselves. Lucas, why don't you go first?
Yep, I could go first. So Lucas, founding contributor of Renzo. John and I have got to know each other very well this year. We actually live about 10 minutes from each other. And Renzo has started off 2 years ago as a restaking protocol that we built on top of EigenCloud. The original goal of Renzo was we had to bring a product to market, and we did that with an LRT named EasyETH, growing it into 1.4 billion in deposits today. But the original vision for Renzo was to be able to build and offer different kind of products on top of EigenCloud, depending on the risk profiles of the different services and products that we're looking to be able to underwrite different kind of security. So when John first approached me, I think it was like February, right before Eat Denver this year, and told me about this idea and this problem that he was trying to solve, very quickly over a really nice sushi dinner that we had, we started just talking about how it's possible to do that on EigenCloud and how Renzo has actually built a tech stack that has a ton of customization that hasn't been used before that would allow him to essentially launch this vehicle. So it's just great to see that a few months later, we've been able to put together the initial proof of concept and actually roll it out to the market. And we'll cover that today on the call.
Thanks, Lucas. Robert Drost from the Eigen Foundation. Sir, you are up. Please introduce yourself to the
Hey. Yeah, Robert. I joined EigenCloud about 2 years ago at this point. EigenCloud is a huge mission here. I think it's been very hard for us to see the map of exactly how the entire enormity of the internet and all web apps and then also all real world, business is able to start leveraging crypto. It's been very focused on DeFi. But with restaking and making essentially the capital in crypto be a lot more accessible across more use cases, just kind of providing the framework for it, and then letting a lot of people in ABSs just very quickly build up some kind of use case and instrument it without having to launch a new layer 1 or a new layer 2, or you can still launch your own token and utilize it, but you also have a huge amount of security accessible. So just very passionate about that. John, a number of us kind of know the whole consensus crowd, consensus alumni or mafia, or whatever you want to call it. That was, I did about 6 years for Joe at Consensus as, leading R&D over at Consensus Mesh. And so, that's generally the background. So I'm on the business side now, but classically I was more a development side, PhD in CS, and just did a whole bunch of stuff in startups ahead of this. So I have a lot of compassion for founders because I've founded companies and taken them through the whole VC cycle and had to sell them and everything else. So a big fan of what John's been doing.
Thanks, Robert. So why don't I'm going to kick into a little bit about and tell the audience here, like a little bit about traditional healthcare insurance and how it works before we get into that. But it's just a foreshadowing. We're going to talk about what we're launching. Then we're going to get into kind of how it works. And then I think why it matters is pretty obvious, but we're going to kind of talk a little bit about that and sort of the social impetus of kind of what we're doing here. And then kind of talk about where we are and what's next, because we're not there yet. I mean, this is a multifaceted launch approach because if you've paid any attention to healthcare insurance, it's a juggernaut, and it is one that is well protected with moats and armies and lobbyists and capital and everything else. So in just kind of sailing right into what's wrong with currently healthcare insurance, I'm sure if I ask this question, everybody in the audience is going to raise their hands. Has your premiums in healthcare insurance gone up in the past 5 years? And I don't think it's just, I don't know, this. I mean, it's like, yeah, it's gone up a lot. There's a lot of legislation and things that have been done over the years to try to, make healthcare insurance more affordable for people. At least that's the stated purpose and goal. But like many things, well-intended things, they end up having unintended consequences. And the unintended consequences of the Affordable Care Act in the US is that it's not only unaffordable, it's not that good a care. So like the Affordable Care Act is kind of an oxymoron at this point for most people. Then there you talk about the constituent groups that get left out. I mean, independent workers, like lots of Web3 people, where we started at Opolis providing support, employment, paychecks, W-2s, compliance, payroll, and benefits. These people don't have a home. They work for a DAO, or they just kind of float around doing freelance, and they didn't really have any of the ways to replicate those typical accoutrements of traditional employment. And so we set out to build a platform that was the bridge between Web 2 and this sort of future network state that we're all trying to build in Web 3. And we learned pretty quickly that just sort of being the go-between between the future world and the existing world is not going to work. And largely we learned this through our health insurance experience. The number one product feature that people came to Opolis for and continue to come to Opolis for under the version 1.0 product is not payroll, and it's not proof of income. It's healthcare insurance, because they know that they can't get a quality plan on their state exchange and actually have it be affordable, so they can come to Opolis and get much better care at a better rate. So it's an obvious no-brainer to come here if you know about it. And we've grown that platform from zero in 2021 to over $60 million in payroll annually. So it's obviously a thing. But then we ran into like dealing with becoming self-insured and becoming our own broker and our own agent to like broker ourselves our own healthcare plans, like all in the spirit of like saving costs and generating revenue for the community. We realized that the incumbent players, they don't want to play with this. Now, unfortunately, it's a permissioned world in healthcare insurance, and it's really he who owns the finance stack controls everything. And that's either healthcare insurance companies, or behind the curtain, it's the reinsurance and bond companies that actually manage the risk for the healthcare industry that really control everything. Now, when you're taking the most profitable cohort, independent workers, of insurance companies and putting them into a group to arbitrage price, provide better care, all of that becomes more expensive for the people that are using the services, right? So, or it becomes more expensive, for the providers, right? So they're losing money by us doing this. Thus, they don't really like it. They like things being inefficient. They like things working the way that they work. So after a big run-in with you could say an incumbent, a large incumbent, multi-billion-dollar incumbent, where they just decided to stop paying our claims for reinsurance, we had a big wake-up call. And we're like, well, look, if they're messing with us at this size, imagine when we're doing $6 billion in payroll, forget 60 million, what could they do then? And looking down the road, none of this is going to get easier. It's going to get harder. It's going to get worse. So then we started pulling it apart. we started picking at the seams going, okay, well, what would we need to do to actually just take this over? Like, what if we were able to provide our own reinsurance backing? What if we were able to do that through a transparent, like a trust layer on chain, and actually bring transparency and ethics back to what should be a gold standard type business instead of a cartel run business? Like, what if we could actually do that? So then we started breaking down all the different layers of risk management and finance behind that curtain that nobody really at the retail side sees, to come up with this holistic approach to taking healthcare insurance on chain. So we're starting with the reinsurance bonds. And the first question is, well, why? Well, here's how it works. When you go to the doctor and you have a health insurance plan through your employer, you pay a monthly premium. Everybody knows that. Well, that money goes into a pot. And every time there's a claim that comes out of that group, money comes out of that pot to pay for that claim. And the insurance works when, certain percentage of people are having claims and then the rest of everybody else isn't. So everyone's kind of getting subsidized depending on the year. And then there's a profit margin for the company to make. And that's how that works. Well, what happens when somebody has a really bad year? What happens when somebody gets really sick? Well, there's these products that you can buy as a self-insured or as a group that are called reinsurance or spec insurance or stop loss insurance. These are all things that are layered behind that curtain to cover these costs in case of those kind of situations. So what reinsurance is in the context of Web3 is we're taking that existing framework, which is usually a life insurance company who's earning a bond yield, or some other pool of capital that's there, and they're going to earn a yield because the companies who are being underwritten are paying a premium to be covered. So there's more money that comes into the pot above those premiums into this other bucket to cover that risk. And then they make a profit because usually they pay out less than they take in. And it's very lucrative for them, actually. And these are very predictable yields. So if you start reading the tea leaves here of what I'm getting at, we could recreate all of this on chain now with restaking and people looking for additional yield on staked ETH, or just even pools of capital that have different risk profiles that ultimately take all of this community risk and put it into a decentralized finance rail on chain, transparent, no bullshit, cut out the bloat, and ultimately save people more money at the premium level by doing that. So when you're getting care at the doctor level and you're just a consumer of this, your premiums are going to come down because we're cutting out all that garbage. So anyway, I'm going to pass the mic here to Lucas to talk about what reinsurance bonds actually are and how they work, because Renzo protocol is the technology on top of Eigen that we've used to actually launch these vaults. And obviously with Opus 1, the one that we just launched last week, Lucas, was pretty successful and shows that there's definitely demand for real world applications in this space. So tell us more about reinsurance bonds and how all this works and how we're creating transparency and sort of, this next generation of support for healthcare.
Yeah. So EigenLayer in general, the best way to think about it is it's a marketplace to connect companies like Opolis and John and his problems to capital that is available on chain that is looking for different opportunities to be put to work. And in the case of Opolis and a recent announcement that we made at Renzo, the announcement of Flow Vaults that we've launched on top of EigenLayer, allows you to essentially customize any kind of basket of pools and capital formation that's needed to underwrite that risk. So it's great that John and his team and the mission that they're trying to solve around healthcare was the first use case, the first real life use case. And when we say the first real life use case, in a lot of cases within DeFi and on chain, everybody always wants to know where the yield is coming from. What is the risk associated with the yield? And over the years, it's become really difficult to essentially have more use cases and have real yield. A lot of times, yield is subsidized to essentially help bootstrap projects. But in the case of Opolis and the bonds that we're launching, there's a real life application that is searching for capital um, that then they're able to return a certain yield or reward those users for underwriting that risk. So, um, in the case of Opolis, what essentially we've launched is, as John was saying, a reinsurance bond. And the reason we're calling it a reinsurance bond is we are underwriting insurance. It happens to be with Opolis and their team in the healthcare space, but it's a fixed duration vehicle. So when we set up this smart contract essentially we define what asset we want to be able to take in. We used Agora AUSD because it's a yield bearing stable coin. So as those funds are sitting in the smart contract, they're going to be able to generate yield from Agora. We're able to define how much capital is needed. So sometimes you don't need hundreds of millions of dollars. Sometimes you might need $500,000 in this case, or $20 million to then be able to use that capital to underwrite something in the real world. So we used AUSD because it's a yielding stablecoin. We determined that for this first vehicle, we wanted to make sure that we were able to gauge the supply demand in the market for a vehicle like this. So the bond was set to $500,000. And we did a maturity date of 6 months, which means that once the money is deposited into the smart contract, um, it can't be withdrawn for 6 months. And in 6 months, when it matures, you will receive your principal deposit back plus the yield that Opolis is projecting on this bond. In this case, 40% annualized, so 20% return on 6 months. The cool thing about this is we're able to do this on EigenLayer. You might say, why do it on EigenLayer? Why not just launch a smart contract that does that? Well, EigenLayer recently enabled redistribution. And although this specific bond is, I'll let John talk about the risks, but all they're using this capital for is to be able to underwrite additional lives that are then going to be paying premiums into their health insurance pool. So they don't have to draw down. They don't in crypto world we talk about slashing. We don't have to draw down on the funds in that bond, but with the technology that EigenLayer has built, it allows us in the future as we create different risk pools. So we could launch a low, high, medium risk bond, and they could have different risk returns to them. Um, they be able to in the future to be able to draw down on the capital that's sitting in that bond and then let the premiums come in and replenish that bond plus the leftover that's there from the savings. So um, for us, this is extremely exciting. We're not looking at big numbers yet. We're trying to prove out a use case that there is demand and then there's supply at the other end of the market to be able to underwrite different kinds of risks. So in the future, you're going to see bigger number bonds. You're going to see different risk profiles. In the case of Opolis, those risks are going to be associated with the lives that they're underwriting and the premiums that get paid in based on maybe some of the medical. John's going to be able to explain it, but some of the expenditures that are associated with those lives, and it's all thanks to this redistribution technology that EigenLayer has built with this marketplace where supply and demand can meet. in a safe and transparent way. People in Web3 are able to generate real yield, and John on the Opolis side is able to solve a real life problem by being able to have access to capital to run a real business. So I'll pause there, John. Correct me with anything that I said that might be inaccurate. I'm not the healthcare expert here,
No,
but
no, you're entirely right. I mean, most people don't understand how the risk is managed in healthcare insurance. Like you just think that, yeah, I pay my premiums and I just, get healthcare and it's great. But, when you start comparing that against what things actually cost, I mean, I went to the ER and saw the doctor for 10 minutes, didn't have any procedures done. And when I got the bill, it was $16,000. And it's just like, for what? And like, then it's like the insurance discounts because I'm in network and all this. And then they come down and it's still $3,000. So you're supposedly getting a good deal. And it's just like, this is what we insure, right? This is the risk management that has to come through here because your monthly premium doesn't cover this stuff anymore. And there's so much exploitation and bloat that exists in the system, not to mention denying claims and dragging their feet on claims and making things hard. There's just so much opacity that like you can't get past. The bureaucracy and opacity of healthcare insurance is incurable. There's not a thing that we can do to build this trust layer, which actually brings me to Robert. Let's talk about the trust layer. Let's talk about how, this is really a fundamental remake of something that we all understand, but we're doing it and building it in a way where we can actually, it's not just about the yield, right? That's a part of the game design that we're trying to build in a more sustainable framework on chain. So tell us about that. Tell us why, how this infrastructure supports this, and maybe even why EigenLayer sees this as such an important social movement. Because again, this isn't just DeFi degens having fun making yield. This is actually real stuff.
Absolutely. It's a great lead in. Yeah, I mean, I think probably, well, maybe some people that are calling in that are using Opolis are interested in like how you did this, John. And so they may be less familiar on the crypto side. So I'll just say like the idea of restaking and the idea of essentially using crypto for much more generalized ways to provide crypto economic security than you get inside of like a given blockchain L1. That was really like the big insight eureka that Sriram Kannan, the founder of EigenLayer, came up with back in 2021 timeframe. Actually, mostly he was building 2022 after the market had crashed, but knew this was of course going to come around. And the observation was, really a lot of this, these funding in crypto were very focused on the DeFi side, but hard to kind of break out into a lot of new use cases because the crypto economic security is very much like coupled into the chain. You can kind of call it monolithic. The chain has a certain level of security. It has, its token, which is like being used in proof of stake. And then it has, all of the goodies on top, the virtual machines, the data layer, and so forth. But the chain doesn't entirely exist there. People think DeFi, hey, everything's on chain, that's great. But already you can see kind of a chink in the armor because if the oracle's reporting the wrong price data from the outside world onto a chain, then you're screwed, right? If suddenly an oracle just, is hacked and it broadcasts that Bitcoin is $5, yeah, there's going to be a lot of liquidated positions. A lot of people are going to be really happy, receiving $100,000 plus Bitcoin in liquidations, as if it was $5. And we have a lot of centralized infrastructure. It's hard to like bootstrap and do something bigger. So there was this idea of like, let's actually create a marketplace where essentially we would invite a lot of participants. And we originally just referred to them as like stakers, implying kind of individual stakers, but that's really morphed over to much more professional operators like Renzo that operate pools and that themselves provide a huge value add to people because it's their business to figure out and create great opportunities for yield. Like this with Opolis, if you were trying to go and explain this to, the hundreds of thousands of people staking on EigenLayer, it's a lot more complicated than, they build trust inside of a pool, kind of like, you have your investment partners in the real world. And, and so fundamentally, EigenLayer just has this inherent thing, which is this marketplace of providing a good place that you put capital that's not just sitting in an on-chain type yield opportunity, but it can be applied to a lot of new, DePIN infrastructure, things around like what would be transitioning the Web2 cloud from trusting Amazon and trusting, like single points of failure like OpenAI and others, but instead then, actually having all of those computations backed up, and then not having like, hey, a new protocol is created, it wants to create, a couple $1 million of crypto economic security. It's a hard time to like bootstrap, but instead just being able to rent, security, go to, Renzo stakers or someone, and then just put up, hey, here's something I want to do with this money, and then, figure out a price discovery like you guys did with this one. And so just, it's marketplace of, good place to put capital. I think we're just under $20 billion of total TVL in the overall marketplace. And, ABSs, got hundreds of them in the pipeline, almost 100 of them running right now. And then in terms of operator, we have like over 1,000 operators. All the major ones are playing there. And then, you'll have people that are actually asset managers that will go ahead and actually just run their own operators. So they're not even using external people. But everybody's sort of like, you'd look first and you're like, okay, that's great, we're going to run the web. But that's a tiny little thing. I mean, the entire world has trillions of dollars of business transactions that are happening. And, like John is saying here, like health insurance itself is insurance. And now you have like some financial people that are providing insurance to the insurers. And, just like we're used to rehypothecation, there is this like, it's not well, it's in a sense putting risk onto other people that are taking like more uncertain, high risk of, you guys aren't doing it in this case, but redistribution means in general that, someone is basically saying, hey, if these slashing conditions occur, then the funds that were slashed are actually going to go to a productive use. They're not, well, productive use relative to the AVS. They're not just going to go into like burning an underlying protocol token. Everybody's kind of seen that in something like Ethereum or other ones. And it's like, okay, that's what you do. You burn fees. And of course, you can be a lot more nuanced than that. And that unlocks a lot of opportunities. So this idea of like, what do you actually need to do business? It's actually one view on like why blockchains are so efficient. In the case of things you can do on chain with VMs, with objective proofs where code is law, blockchains essentially make the transaction risk, that friction from transaction risk, essentially zero. I mean, nearly zero, as long as you just, you don't believe people are going to hack Ethereum. But there's trillions of dollars more of transactions happening, really on a daily basis because there's so many funds moving through and other things. And there's people that are experts that weigh in. They comp out what the risk would be. They look at the risk-adjusted reward of like what they would get for taking on these risks, and that's just how business operates. So, seeing that kind of happen here, and then allowing there's 20, approaching 20 billion in EigenLayer. Eventually, looking at all sorts of assets that are coming on and so forth, there's the possibility that crypto can really scale, where the trillions of dollars that we're going to have in crypto on this cycle are able to be going to these real world business opportunities and bringing a ton of additional revenue. People say RWAs, and they're only thinking of like T-bills and like simple instruments, but like these are real world
or
use
real
cases.
estate or whatever.
Or real estate, and it's just very asset tied. But if you look at this case with Opolis, there's not really like an asset that has to be behind it, right? You're bringing your own asset and you're taking on risk, right? You're not buying, something there, although you kind of wrap it into a bond, but you're not owning part of Opolis or something as part of this. You're providing a function for your money, and that fluid value of the money becomes something that's valuable on itself. So it's much more on like the revenue risk reward side. The transparency is really important here. Obviously, it's very capital efficient to have this money available and move it around all over the place. But risk reward is only something that people can do well if we have everything very exposed. And so one of the things here is just allowing people to have tons of information. It's one of the reasons on EigenLayer we built this incredible EigenDA layer. Yesterday we announced that we upgraded our performance from 15 megabytes per second to 100 megabytes per second. That's available now. And we also gave people the information that, we're looking roughly Q3 timeframe this year to be hitting a gigabyte per second, because we just want people to have this. Don't worry about data, like think bigger, think bigger. You can build better applications without being limited by, data availability in the hundreds of kilobytes or megabytes. But the reason we have that is you have to have transparency in the information that everyone is like settling their disputes and disagreements on. And as much as possible on chain, you actually just do ZK proofs and other things. But fundamentally, sometimes you have things that require, off-chain views. Like, we actually are, we did a big deal with Polymarket and UMA, where things like there was unfortunately a hack around UMA, and EigenLayer can actually back that up because our fundamental underlying Eigen token can actually absorb and be forked inside of DeFi based on people who are attacking and doing the wrong sorts of behavior. So we're actually the final stop behind prediction markets now on Polychain. If everything else is hacked, then eventually the community can fix that by using the EigenLayer backing system. So, it gets kind of deeper. If you want to look at the technology or other things, there's a ton of stuff written about it. Some of the really innovative stuff, people are always like, oh, you can only do things with majority. There's always a hack that you can do. And, in reality, the transparency here is once people know a hack happened, you can actually have the minority win, which is, really exciting here. And we know these have happened in history, like, something like Ethereum, for instance. The original Ethereum chain was ETC. And ETH was the chain forked off from it because of the DAO hack. And the community intersubjectively decided that was the right chain. And you can do that as well if you have the right kind of crypto economic protocol. So this interface of allowing off-chain adjudication to determine what happens, with on-chain funds is the really critical part. And, creative people like John here can figure out something that is worthwhile and that is actually bringing a lot of money on chain because they're able to run a business that makes them more money. So great.
Yeah, well, Robert, if I ever need to, I came up and watched your guest lecture at University of Colorado with Danny Ryan's intro to blockchains class, and had I known it was 3 hours, I would have brought more comfortable clothes to kind of hang out in, but I don't think there's anybody I know that has a better grasp of the theory around crypto economic security and, even philosophically, like what we're trying to accomplish from a business case wise, not just the technology, but how it merges and how then we kind of build these use cases on top. I mean, it's been a really super fun partnership, and like to see RealFi come alive and actually become a thing. Like I said, RWA really is an asset thing. It's like we have assets, and that's real world assets for those that don't know what RWA is. But there's a whole new thing coming here. So before I get into the what's next and why this matters, I'm going to just put a call out to the folks listening here. If you have a question, dump it in the comments of X or YouTube. And we actually have a moderator who's watching them, and they'll make sure that we see them. So after I do this sort of what's next section, we'll answer some questions for the group here, and then we'll kind of go through some whatever questions happen to pop up, and then we'll kind of conclude with kind of talking about sort of futuristically what we think the vision for the next steps are. So in terms of why this matters. So my journey around healthcare and employment started in 2005. And for those that don't know my background, I actually come from an employment systems and HR tech background. So I started as an entrepreneur in my mid-20s, and I've been doing startups and businesses and starting and selling things for a very, very long time. And it was one of those things that when Obamacare came into the picture, our business at the time was not required to actually offer health insurance, as running a consulting practice. And then it became anybody with over 50 employees, and we had like 700 of them, were required to now offer insurance. And then, most of my industry actually leaned out. They were trying to find loopholes and ways to creatively organize their companies so they all had 49 or whatever it might have been. You know, they hired really expensive attorneys to basically find the gaps, right? To be compliant, but kind of lean out of the spirit of it. Well, we actually took the opposite approach. We decided to start offering healthcare insurance. So I designed our first healthcare insurance plan back in 2010. So we've done this for a very, very long time as part of a larger bucket of services, though. So when you get a front row seat to the egregiousness, and I saw a comment pop in here, you know, are you guys planning on fighting against egregious medical billing practices? That's part of it. Okay, there is so much bloat and so much corruption and so much and just opacity around why things happen the way that they happen, that it's a terminal illness. The industry cannot be helped. They don't have incentive to do something different. So there's a saying in business that you learn, it's like, don't hate the player, hate the game. And unfortunately, all of this 20 years of travels of mine has brought me to the conclusion that, look, you can hate on the players, but they're only doing what they're being incentivized to do. As a publicly traded healthcare insurance company, whoever it might be, I won't even name names, you know who they are, okay? Their CEOs are incentivized to maximize profits. They're Delaware C Corps. And to do that, especially with a 15% cap on profits that they can make, the only way to make number go up in terms of their stock price, which is how they manage profits, is to make revenues go up. And the only way to make revenues go up is to, you know, kind of be a little shady shadester on various ends of the business and incentivize people to do things that maybe they wouldn't otherwise do because they need the revenues to go up. So like, we can say that they're bad people, but I don't think that's helpful. I think it's what Robert talked about, the transparency around this social movement of, it's not even about healthcare insurance. It's really about the health of Americans and health of people globally, that health insurance is a big part of this in our normal day-to-days. So we've got to figure out how to solve it. And it's really through better game design and transparency that we can do that. So why does this matter? Well, when you own the capital pools as a community and you're underwriting the risk through the community with a yield, okay, so this isn't just, you know, again, subsidizing with somebody's protocol token that's getting burned. This is real yield with real coverage on real people having real health needs. That, again, this is about as intimate as it gets when it comes to social matters that matter. And so we're going to take this entire thing and we're going to just redress it and build a new game. So the game system then being more transparent, straightforward, not incentivized to put the bloat in. Our organizations, if anybody's followed some of my other work, we're big in promoting cooperatives as a framework for wrapping DAOs, and cooperatives can be for profit. And so it's not about, you know, I think one of the things, you know, that I think our industry is meant well about is we talk a lot about public goods, but we kind of forget that human nature, and one of the best coordinating mechanisms, to quote my friend Griff Green, over the past 500 years is profit. And if we don't, if all we think is we're just going to, you know, how do we incentivize good human behavior just because people are good people? Well, look, I would argue that most of the people operating in these healthcare companies are not bad people. The game just incentivizes them with a misalignment, right? Incentivizes them selfishly to do things that are out of alignment with the greater good. And so the real trick here is, how do we actually align the incentives of the selfish individual with that of the collective? And that's what Web3 is. And that's what we're doing here with health insurance and bringing it on chain. But we can't just go after the bonds. That won't work. Because to the point of the question asker, you're not going to solve the medical billing practices doing that. You have to go all the way down. You have to take all the risk all the way down to the premiums and healthcare insurance to the patient layer. So how are we doing that? So let's talk about that. What's next is Coalition Healthcare. It's launching January 1, 2026. We are looking for 6,000 lives to come on board to this so that we can build our own unique privately owned captive. Now, if you don't know what a captive is, there's about 7,000 of them in the US. It's a coagulation or a group of people from various employers and various backgrounds that are all in one underwriting pool. So in order to own the entire stack, we need to get to about 6,000 lives to have, like Robert said, you can't bootstrap this stuff. You got to have the girth and the size, and we need about 6,000 people to do it. Now at Opolis, we've got about 600 people already. We've got several groups, even some government agencies and other folks that are looking at this, big law firms, other crypto companies, protocols. Anybody who's got groups of US employees, we will want to talk to you. So how is this going to look? Well, imagine no deductibles and no copays. Now, how the fuck are you doing that, John? I bleeped myself. You like that? How are you doing that, John? Well, we're going to do that we're going to do what's called cash pay coverage. So through some very creative mechanisms, you'll have the ability to pre-authorize services that you need. But instead of just getting a pre-authorization as permission to go do it, we're going to pay for it up front. We're going to negotiate with every provider up front a cash pay price based on, there's metrics that get used in the healthcare industry, like what Medicare pays, what Medicaid pays, what average providers pay. And there's ways to go in with this information to hit the provider right between the eyes and say, okay, that guy needs an e-scope. We're going to pay you X amount of dollars and we'll pay you right now. Or you'll have a P card that's loaded with USDC that's on chain and transparent in our risk pools, and they'll just swipe it and that will just take the money right out of the pool. You don't even have to touch the money. You don't have to see a bill. You don't have to pay a copay. You don't have to do anything. Now, out of the box, forget that for a second. Doing that's going to save everybody a ton of money on your premiums, because we're going to cut out a bunch of costs when it comes to all the administrative bloat that health insurance companies love to pump into your premiums, right? Billings and collections and write-offs and all this other stuff is a thing of the past, because we're going to go directly to the providers and take care of it for you. Secondly, hard costs are going to come down probably by about 10%, because we're going to be so much more efficient leveraging technologies like AI for claims processing, et cetera, et cetera. Third thing is prescriptions. And if you don't know, but prescriptions are a racket of monumental epic proportions. And we have the ability to cut out about 90% of cost on prescriptions with some partnerships that we have. So that's about, in terms of your premium cost, about 10%. So 10% on prescriptions, 10% on hard costs. And then if we do this at scale, anywhere between 20 and 30% in other costs that affect your premiums. So the net effect at scale of this is, our models show that we should be able to save between 30 and 50% on healthcare premiums out of the box. Okay, now some of this is going to boil down to the risk of your pool. If you have a healthy pool, you're in great shape. If you have people with a lot of claims, we have to underwrite you differently. So, it's all about risk management, and there are hard costs to this. So, if you think that getting, super sick and all of that, it doesn't have a cost, it does. And we have to be careful about that. Now, the other thing that can happen is the risk pools that we're using, and even some of the methodologies that we're going to use in the future to underwrite higher risk groups or individuals. There is so much money that gets printed at this, but instead of it bleeding out of the system, all this yield and all this profit and all the premiums and all the profit that not just Opolis, but everyone in the system is making, we create incentive to reinvest it in the community. And then you have these subsidy pools that will come in the later stage at maturity that will then underwrite and subsidize the premium costs even more on behalf of the community. Because again, those profits aren't leaking out, they're staying in. So then you reduce costs even more. So that's how it's going to work. And so when you are, we're going to do a bunch of things here in the fall. There's going to be more bonds launching. So Opus 2 will be launching sometime around September, October. It's going to be a much bigger bond. But in the meantime, the call to action here, the ask, if you will, is, your own health insurance, your company, whoever it is, come and talk to us. Now, the first question that we always get is like, well, you're Yeah. Is it risky? Is it legit? We'll have a conversation about that, but we're not doing anything different than everybody else is already doing when it comes to compliance and how things have to work administratively and what the laws are. The main difference here is that we're going to be operating on behalf of actually bringing transparency and ethics and humanism back to healthcare instead of this cabal of nonsense that we currently have. All right, so we got a couple of other questions here. I'm going to jump into them, guys, if you don't mind. And some of these seem very healthcare insurance specific, so I'll see if I can answer them. Are you guys utilizing cost change ratio values available in AHG to determine cash pay amounts? Yes, we are. Some provider facilities overinflate amounts for cardiac cash pay. Well, we're also using Medicare base rates, so that's publicly available information. So we understand that the cash inflation rates when you call into the doctor by yourself, if you just ask them like, hey, what's it cost me if I use my insurance or if I just do this on my own? Like I did this when I had a hernia replacement or repair, I should say, 5 years ago. I got a cash pay rate like half the cost of what they're charging my insurance. And I'm like, well, if you don't want to use your insurance, we'll charge you less essentially. And I'm like, that's weird. So we know how to play that game. So the answer to that question is we're using also the Medicare and Medicaid base rates, which we know, and to negotiate against them. Next question. Funny thing about scripts, I'm on one for the rest of my life. $130 per fill with my insurance, 20 bucks with no insurance, and medical coupon I always find. Can you guys find the magical coupon? Yeah, well, we know how to game this. That yes, okay. So the answer is it's a freaking game, and it doesn't cost them $132. That's just what they call the negotiated rate for the insurance plan. So because we're doing it this way, $28 might even be high compared to what we're able to get it. Because again, we're going to know what Medicare pays and we're going to know what everybody else is paying. And we're going to go in and pay for these things in advance. So like, and then once you get on your mail order with us, it's just like routine. You don't even have to do anything as long as your script is maintained on your doctor provider side. All right. Those are the two that I see right now. Do we have more questions? Do we have any questions for Lucas on bonds and restaking? Do we have any questions for Robert on infrastructure and any of the, reasons that we're doing these things in conjunction with each other in partnership?
I will
John,
say, by the way, on prescriptions, one really fun thing, if you want to just see somebody who's passionate about it and did a lot of work on it, Mark Cuban, very kind of knowledgeable person on crypto, who's just like, this prescription racket is absolutely ridiculous. And, like you said, I mean, it's just so much hidden information. And, there's an entire market of like going through finance, going through healthcare finance. And it's all about how to just essentially, hide things. Information asymmetry is it's the antithesis to like very good, efficient markets. So, yeah, so it's really great to hear, how competent you guys are putting things together for that.
Robert, I don't know about you, but I think I've learned more about healthcare and insurance, and it's impressive to actually see community members that are very well versed in some of the issues that they have. So,
well, when you know, and if you've had to go down the rabbit hole, like our question asker here who was asking about this, I'm on this script for the rest of my life. This is not an uncommon thing, actually. And when you have to traverse down that road, you find out that none of these folks are your friends. And then if you lose your healthcare insurance, and maybe it's not the other way, without insurance, it's $28. So it's like, why do I even have insurance if like you're not going to pay for it? Sometimes it's $500 without insurance, right? So like, it can go the other way easily. And so people feel beholden to the jobs they have. And, even as an independent worker, you can't get good coverage. So like, we know people that have left independent work to go back to, to working for big companies because they have better care. So what we're saying is like, look, we're bringing groups and big companies, and we're still going to take care of the independent workers. Eventually, when the network state matures and most people are freelancers anyway, we're going to be here and just evolve with it. But Yeah, I mean, it's amazing how much you don't know about something that is so just commonplace that everybody has, right? It kind of reminds me of one of the other sports that we deal with is like, organization formation and, people who are trying to payroll themselves and S corps and all this kind of compliance stuff. You've heard about this stuff, but until you get into the guts of it, you don't really understand the compliance and the statutes and all the things that you got to do. Healthcare is like 100x of that, 1,000x of that. Most people know very, very little about actually what goes on. And the public narrative from the healthcare companies is always like, well, costs are going up and, all this kind of like hand-wringing stuff. But really, it's just they're managing profits. And in order to do that, they've got to have number go up in revenues because they're capped at how much their ratio of profits, 15% that they can make. And whatever narrative they got to spin to make it okay for them to jack rates and be slow and be inefficient and hide things from you, they're going to do because that's profit for them. Mm-hmm. And again, the fiduciary duty of a C Corp officer or director, if you don't know, is to maximize profits on behalf of its shareholders. So again, don't hate the players, hate the game. The game is designed that way. Now, we're also not arguing to hate capitalism. We're just saying the game mechanism is flawed and misaligned. All we're saying is we're using existing frameworks, new technologies, and new game design to create and sustain better outcomes. Eliminate the frictions and align, like I said earlier, the individuals with that of the group in behavior. That's never been done, and that's what Web3 enables us to do. So there's another question. Go ahead.
Capitalism is only efficient if the market is efficient. And correct. If a ton of information is being withheld, you're not going to get that. Generally, companies are just always in, the prior economy, everybody just wanted to hide information. One of the interesting things about the seminal invention of crypto with Bitcoin was that it incentivized people to share information as quickly as possible and propagate as quickly as possible. Like once you had a winning hash, you want to advertise it right away. Once somebody sends you a winning hash, you start mining on it, you want to send that on. So thinking really creatively about games that incentivize people to have this creating efficient marketplace is massive. I should just say, for people looking, the amazing thing, and I know you're kind of talking here about people that already have preformed groups, but, Opolis for gig workers, which is these problems that are just not solvable. But the idea that you can actually fuse together a few different jobs, be on Opolis, get the insurance that you want. This is really next generation stuff. And,
it is.
I'll say some people who are calling in may be just interested in like, hey, how can I use crypto in something that's more real world? And I would say, build something and then use Opolis for, for what you need in order to handle everything related to your employment. But then the second one I would say is just look at this example, the idea of taking difficult real world situations that are very hard to fix right now and applying crypto in these ways, huge business and huge opportunity. And, and you can actually, you're not limited starting from a completely new network anymore. Look at technologies like ZKTLS. You want to create a new rideshare company, you can actually have everyone, riders and drivers, pull all of their reputation data off of the existing systems. And in general, this is sort of like the kind of way to punch through all this, all of this, hidden information that people are putting behind your login ID, and it can be done privately and everything else. So, this sort of real world use. I mean, there's, in general, crypto had just, on-chain, very crypto focused. The second generation is just moving apps in the cloud and the internet over. And then what you're already doing here, John, is, showing people that the third generation of this is crypto is now underwriting risks and helping handle the monetary flows of essentially every business. So it's handling
Correct.
the financial back-end layer, the yields, the risks, and the rest of it is just a very ordinary looking business. The whole time you're talking about this insurance, like there's no mention of crypto in any of this, right? This is
well, and if you do that, everyone's brains go and they don't know what to do with it. So like we're trying to keep it very simple and straightforward, and just under the hood. I said this in 2017. I was like, I see a world where It's like the TCP/IP, HTTPS. Like nobody cares about the underlying protocols. Like we just use the internet.
I do.
Like, well, you do, yes, because you're the guy who knows how to like teach about it. But like, I know about as much about that stuff as now you know about healthcare insurance. So like, you
100%.
can't be an expert in everything. And like, when you talk about average everyday people who don't even have as much knowledge as we have in these various subjects, like it's tough. So you can't educate your way to mass adoption is what I always say. So you've got to abstract these complexities away and just make better, cheaper, faster. And you've got to do it though in game design with better incentives that incentivize the efficiencies, the transparencies, and ultimately more profitable outcomes for not just shareholders but stakeholders in a much larger context. So like I think we're definitely on the right track, and I think we've now got the technologies like ZK, what is it, TLS that you just talked about? Like that's cutting edge stuff. I mean, we haven't even in the last year been able to do that. Pre-EigenLayer and Renzo, we weren't able to do any of this. So like we've advanced the ball now to where we can actually go out and tackle real world use cases. And again, we're calling this RealFi between the group of us here because we think there's a new category being formed here. That you're going to see this template, if you will, applied to many, many things, if not almost everything that touches consumers. So with that, go ahead, Lucas. I was just going to pass it to you.
Yeah, I was just going to say, usually when I don't have to talk a lot about explaining the tech and everything else, I know I'm in the right room, especially when you're using that tech and you don't need to worry about what's going on in the background. So I think on our side, on the Renzo side, like John mentioned, you're going to see additional bonds launch. The first one that we launched last week closed out. The 500K was deposited within, I think, hours, and will help the Opolis team kind of secure lives ahead of the next open enrollment. John mentioned that there's going to be other bonds rolling out in September and October. Please, follow Renzo, turn on your notifications, all that fun stuff. Go to renzoprotocol.com. You'll see we've added a new section under restaking called bonds. And in the future, also, if you're a builder in the space, or we've had a number of other companies and projects kind of reach out to us. They didn't know this was possible. And what you'll see from Renzo, we've had this technology for quite some time. We just haven't had use cases. What you're going to see over time is you're going to be able to kind of self-service on the Renzo page and be able to launch the bond that you want, or with the right kind of parameters, and be able to go and see what kind of yield opportunities there are. If you're a DeFi user, if you're a company or a project and you're looking for these kind of services, reach out to us. Our team's happy to talk to you, but also look forward to when John doesn't have to call me and his team could just go ahead and announce it and have it on their website, and be able to take deposits into their bond and be able to go on much more important things than how to use Renzo or how the bond actually works. But the piece I'm excited about, we've built these rails over the past 2 years. They exist now. They've been battle tested, and you'll see Renzo essentially launching different kind of products and services around, whether it's bonds. There's a couple other use cases that we're working with teams on. We're seeing a lot of demand from e-treasury companies that want pools of capital to be staked and restaked. So there's a lot of really exciting and fun things that I think the community's been looking since we've started building on EigenLayer 2 years ago. So John, as always, I appreciate all the knowledge and look forward to being back in Denver in a week or two, and we could grab lunch. And Robert, as always, nice connecting. And next time you're coming through Denver, please make sure that you hit up John and I, and we'll take you out to lunch or for a hike in Boulder.
Always great crew out there. Always a great crew. And I should say, John, by the way, that 3-hour lecture, it was 6 30-minute lectures, so it wasn't quite as painful as it might sound. I should
You're
probably
right.
actually, I should probably put that up somewhere because each of those were, fun little
It was
discussions.
actually very good. So like for as long as it was, I was actually quite interested in it. And I think I told you this at the time, but you have an incredibly talented professorial way about you. And I learned a lot personally. So, I'm happy to do it again anytime. So, Robert, final thought from you. Is there any other sort of quick hit real world vision? Any other use cases on EigenCloud that you see coming online that are exciting?
Yeah, I think there have been some discussions on other kind of business use cases where people are forming consortias and they're not able to sort of objectively know upfront that everyone's doing the right thing because they are kind of pooling information. But eventually they all sort of know that it's going to come up almost as like a back auditing thing. So this idea about people putting in kind of stake that allows, the consortia to have trust in each other because they in many cases are some competing businesses or they're on the opposite side of revenue and cost of goods. They're stacked on top of each other, consumer producers. So that's a very interesting one. And then across crypto, I think that you'll see there's a number of protocols. I think cap is one of the recent ones announced, but others that allow you to do kind of a risk arbitrage where you're able to set up different strata of people that are taking increasingly higher risk positions. And risk is fine if it can go up higher. It needs to be transparent. It needs to have, fairness, that you don't have principal agent problems, that someone can steal your money. And then, you can, I mean, sort of along this general line of, imagine somebody takes on 10% of a pool doing something, and they're the first money that is at risk. So the other 90% is like, hey, we'll give up a fraction of like what would have been our yield. And the 10% that's the first money out could like double or even triple their yield. So these types of junior, senior type things are really helpful because, there are many cases where people need something in order to get like big institutions and others, and just all of us to use, crypto. You want to have more stable yields. It's almost like stable coins were critical for crypto because they gave you value that was pegged to the rest of the world, and stable yields are actually something that you can do with these kind of risk transfer systems as well.
Yeah, Robert, on cap finance, we've been working very closely with Benjamin and Westo, have known them for years. That's one of the big use cases that you're going to see launching on Renzo, specifically on EigenLayer. And just like you said, there's going to be different risks, pools of risk that are going to be underwritten. So you're going to see a number of different vehicles, right? I think everybody got so used to LRTs and liquid restaking and the rehypothecation that has happened. And we're finally starting to see some real use cases with Opolis and cap finance where there's going to be a receipt token, just like with John and Opolis One. There's a receipt token. It's going to be cool to see people, even though the maturity on that is 6 months, they could go and actually transact in it. They could go and sell it on a DEX. Maybe somebody's going to want to speculate on what kind of yield. We're going to see these same kind of products with less rehypothecation launching due to some of these teams that are launching products that are looking for a different pool of capital. So Renzo is going to be a very big player there. The team, like Benjamin and Wesso, are awesome and OG builders in the space as well. So keep an eye out towards the end of August for that one to launch. And again, they'll be using Renzo Flow Vaults to help them kind of tier out this risk based on the different risks that are taken. So,
yeah. Well, thanks everybody. There was one little question that came in at the end here that I'm just going to address, and is Opolis moving towards replacing Gusto deal products? No, the whole payroll sort of compliance, product as a service kind of thing that we were doing with Opolis and V1. We're going to continue to do it. It's more of a vehicle, though, to aggregate more users into the healthcare products, and because it's such a bigger issue, we call the employment and compliance stuff necessary evils, right? So you got to do them and you got to deal with it. But in the end, the much bigger impact and needle that we're trying to move is with people and their health and giving them the lives that they want to live with their families, and making these products and just the experience of healthcare more human, more transparent, and more ethical. So with that, I'm going to say thank you, Lucas, Robert. Thank you so much for your time.
You guys have a good day.
Everybody have a wonderful day. And if you're interested in hearing more about Opolis, go to opolis.co/insurance, and we'll see you soon. Take care, everybody.
Take care.
All right. Thank you, guys.